afternoon. My name is Sullivan. I'm the Director of Engagement and Support Services for Ponterra. It's really a pleasure to be here today and share with you some of the business valuation information that we've gathered over the past few years. First, let me start thanking the Vendor Summit team, Richard and his team. They've been really good, and this is actually my first time in this Vendor Summit event, so I'm really looking forward to spending some time with you and learning a bit about trends and opportunities in the industry. Hopefully my presentation is going to be as good as the TIVA presentation, and so we'll show you a couple of tricks as well. Basically, we're going to be talking about business valuation, and really I think it's an interesting and fascinating topic. We get a lot of discussion around business valuation. It's important and it's fascinating because all of the decisions that you take and you make on a day-to-day, whether they are financial, operational, strategic, they really impact the enterprise value of your business. And I'm really talking about the early stage startup community, right? So each and every decision that you make, it will impact that enterprise value. So it's really important to understand what are the key value drivers of the business. So it's not important just to understand what's my enterprise value at this specific moment in time, but really understand that at the end of the day, I'm going to be making decisions that I'm going to be impacting the enterprise value. So what of those decisions, how do they impact those key value drivers? And you have different types of businesses, you have different types of spaces, and for instance, you have in one space recurring revenue over total revenue, you have EBITDA, you have a lot of different metrics that really impact the bottom line, so we'll share those with you. First of all, for those of you who don't know us, we are a boutique global investment banking firm. We specialize in providing valuation specialty services and M&A both on the buy side and sell side to most middle market companies, both in the United States and abroad. And so we focus on the hospitality, travel, food service, and retail. And we've been doing this for the past few years. And we've been doing it not only in the United States, but also in the rest of the world. Basically, what sets us apart is that one of the founding members of Ponterra has been an operator in the industry for over 20 years. So we really understand what are your growing pains, we really understand what are your needs, and we can speak your language. Also, because 70% of our deals involved one international partner, we have a global outlook. So we've been able to gain a lot of information and access to very interesting dynamics in the rest of the world, and we bring that to our clients' benefit. And also, we want to be a one-stop shop for your investment. I'm not going to get into much of a detail here, but basically these are some of the deals where we have been active lately, and so we've been around the four spaces. So really getting into business valuation, what is it really, business valuation? How does it impact my business? How does it impact my finances, right? So basically, business valuation is really having the fair market value of your business done. So in other words, if I were to sell my business today, how much money would I get, right? And this has really, it has to do with understanding your financial and business metrics. So first of all, I want to know exactly, so if I am in a space where buyers or potential buyers are looking at revenue multiples, so they're looking at recurring revenue multiples, they're looking at customer retention rates, I really need to understand how that impacts my enterprise value, because ultimately that's going to drive value. Also, it's important when you're doing business valuation not just to do an internal analysis, and we'll go over that in a minute when we talk about discounted cash flow analysis, but it's also important to really understand how are other companies or how other similar companies trading in the space. I want to see the precedent transactions that can compare to my type of company. So if I were to sell it today, how much money in terms of revenue multiples or EBITDA multiples would I get? So that is really important. As a business valuation practitioner, I can tell you that most of my colleagues will tell you that valuation is more art than science. I actually think it's a combination of both. I think it's art and I think it's science. It's art because when you have 10 different valuation experts conduct a business valuation of your company, there's a very high probability that none of them will arrive at the same number. Why? Because you have different forecasts, you have different set of assumptions, and you really understand and you have different approaches at looking at that valuation engagement, right? It's also a science because ultimately you're going to be engaging into financial modeling. You're going to be doing a lot of sensitivity analysis. You're going to be looking at the different costs of capital. So when you combine both, it's really a mixture of art and science. So why is it important to conduct a business valuation and really understand the whole exercise? It's important because, first of all, you really want to understand what really impacts and drives value in your own business. And it's important to understand that each and every decision that you make, as I said before, is going to impact ultimately that enterprise value. And enterprise value changes every other day. It's not static, it's dynamic, right? So as we move along, as we make decisions, as we grow, as we diversify, as we get into new lines of business, well, definitely that impacts the enterprise value. So it's important to understand that it's not static, it's not written in stone, it'll change over time. So that's when, ideally you want to engage in a process where you're constantly looking at your enterprise value and how those different decisions that you've made along the way hopefully improve that bottom line. Also, you want to engage into strategic planning, right? So actually, we recommend to incorporate business valuation exercise into strategic planning. So we've worked with clients in the past where we see that they may be able to improve that business valuation by 20, 30, 50%, right? If they do the right things over time. So it's really important to plan ahead, have the right action plan, right? And start working on those key initiatives, key strategies that ultimately will be able to improve that bottom line and hopefully increase that enterprise value. And last but not least, exit planning. So, it's important to plan ahead. It's important to understand that exit planning is not done overnight. So if you're really looking to get out and get your chips off the table in 2 or 3 years, make sure that you have the right plan in place, and make the right decisions in order to, whenever you're ready, right? And hopefully it'll be the right time in the market to get out. You'll get the most value out of your business. So there are, in terms of looking at a valuation approach, there are 3 types of methodologies that we look into, right? So for this presentation, I'm going to just focus on the market and income approach. Actually, the asset approach is not really, I would say, effective in today's, for the industry. So looking at the methodology regarding the market-based approach, what we're looking at is how are companies that are similar to mine, how are companies trading and selling in the open market. So I want to see those transactions. I want to see what are the multiples that are getting. I want to see how those transactions have been conducted, under what set of circumstances, and under what market conditions. And so that's really important. Usually what we'll look here is that we'll get a lot of multiples based out of revenues. We're seeing a lot of multiples out of recurrent revenue. So a lot of buyers out there are looking for companies that have a high percentage of total recurring revenue over the total revenue side of the business. So that's really important. Also, we're looking at companies that have higher EBITDA multiples. So usually a company that is growing very fast, it's probably investing a lot of money and capital into growing the business. So that type of business will probably have a lower EBITDA margin than a company that's more mature and it's growing more steadily. So we need to differentiate and understand what's under what sort of circumstances is a company performing. When we look at the key sensitivities, right, it's important when we look at the market approach, it's important to really, select the right comps, the right set of comparables that really can resonate with the type of company that we are in. So even if it's, deal type, the size of the industry, how mature or not mature is the industry, geography-wise. Those types of factors really have an impact on the type of approach that we're going to select. Also, it's important that we are able to compare past transactions within the same type of market conditions. So, for instance, if you were to compare a company that sold at 1x, 2x revenue multiples, maybe it was due to the fact that that company was having problems. Maybe it was close to bankruptcy. Maybe they had a very one-time event that affected that transaction. So we really need to understand under what sort of circumstances is that company being sold for, and really kind of understand that. Looking into the income-based approach, this is an approach that we as valuation practitioners, we practice a lot, and that's the discounted cash flow, which we'll go in a minute. When we look at the market approach, we're looking at what's outside of us. So there's really a lot of things that we cannot control. We cannot control for how much our competitor was sold. We cannot control the market conditions in Asia. We cannot control what are the sort of specific circumstances that a buyer was at a specific point in time. But we can control internally in terms of the discounted cash flow. We can control how we grow the company. We can control the decisions that we make. We can control how much debt or equity we finance our growth. So that has to do with the income approach. In this case, it's really, really important to understand that we usually look regarding market comps. We look at the past, and we look at the past 2 to 3 years and see how companies have been trading in the open market and for how revenue multiples they've been sold at. When we're looking at income approach, we're looking at 5 years down the road. So market goes into the past, income approach goes into the future. So we're looking really to make a forecast of our business, and we'd like to see what's the revenue growth going to be like, what's our margins going to be like, what's our EBITDA going to be like, and at the end of the day, what's the free cash flow that we are expecting to generate. So we take all of that and we discount it at a discount rate to arrive at the net present value, which we'll go there in a second. So it's important to understand that. And so the way we finance growth, the way we utilize equity, or we use debt to finance the company, it'll impact the discount rate, because at the end of the day, the cost of capital impacts the risk of the company. And so that has a direct impact on the enterprise value ultimately. Also, it's very important, and we'll talk over that in a second, the normalizations in a valuation exercise. It's very, very common, especially for the small and medium-sized businesses. It's very common to have normalization adjustments. So these are adjustments that we will do to a company to really make sure that we're seeing the true operating and financial performance of the company. So if they had to, if they engage in a non-recurring, non-operating, one-time event, we're not going to penalize the company because of that, right? So we'll do that adjustment, and we'll report, or we'll reflect it in the adjusted EBITDA. I don't want to get too technical, but I think it's important for you to understand that this is all important in terms of your valuation. So really getting a little bit into the detail of the DCF analysis, it's really the ability to look forward 5 years from now and understanding how can my company generate, how much cash flow can the company generate down the road, and regarding of. And in terms of that ability, it's really important to have the right set of assumptions, because you're really forecasting. So this is the art side of the valuation. So it's important to really understand the past. It's really important to understand the current state of the company. But it's also very important to understand the industry trends and how those trends translate into the company's ability to really generate those free cash flows that ultimately will have an impact on enterprise value. So again, the assumptions part of the discounted cash flow analysis is very important. I can assume that I'm going to be growing at 10%, and maybe another valuation analyst will assume 15%. So we need to really have the right set of assumptions, and we really need to justify those assumptions. So at the end of the day, it's really selecting the right type of assumptions and having the right fundamental analysis to really be able to justify such a decision. We like to actually combine both. So when we're doing a valuation of a company, we're looking at the precedent transaction analysis and seeing, okay, what is the what is the set of comparables that a similar company my size, in my geography, in my market was sold at, and also look at the DCF analysis. So when we combine both, we actually get a better valuation range. It's also important to engage into the sensitivity analysis of valuation, and that means that I can have a different set of scenarios. So I can go from my most pessimistic, conservative scenario to a very aggressive scenario. So when I look at the numbers, I have a range. So I like to stick in the middle of the range to be conservative, but I know that if things go south, I can end up in the lower end of that range. So having that sensitivity analysis, it's good for discussion purposes. It's good to include it into the strategic planning analysis, and we do that all the time with our clients. So I think that it provides value, and it also provides some space for improvement. So really, there are three main components that impact the DCF, and I think it's important, especially for the entrepreneurial early stage community. First of all, the free cash flows. When we look at DCF, we're looking at revenue growth, but ultimately we are looking, at the bottom line. How much free cash flow are you being able to generate? So investors, buyers, partners, they're going to be looking at, okay, how much are you going to be making out of that total revenue line, and how well are you managing that growth, right? So there are a lot of things that go into that free cash flow line. I'm not going to get into that detail, but really that's one very important factor into the DCF analysis. The second part is the discount rate. So really is usually the bigger the company, the smaller the discount rate. So it's really a inverse correlation. It has to do with how much risk does an investor or a potential buyer perceive of that company. So usually, if you have an early stage startup company, probably you'll have 20-25% discount rate. As the company matures, as the company grows, as the company reaches a more stable path, it'll probably can be in anywhere between 15-18%, so that varies, and still that's part of the art side of valuation. Finally, the terminal value, that's really when you end up finalizing that forecast, that 5-year forecast, you end up in a plateau, right? So you've finalized growth, you've reached that plateau. Well, that plateau is called the terminal value. So basically you bring all that future forecasted cash flow into the present, and that's part of a very important part of the enterprise value. So in terms of precedent transaction analysis, it's really how much could you obtain if you sold your company today by looking at similar companies in your vertical. So we look at that all the time. And again, that's looking into the past 2 to 3 years, really selecting what type of companies are similar to mine that were operating under similar circumstances, under very similar market conditions, and they were sold. So I really want to understand that, right? So really there are 4 main factors that influence that precedent transaction analysis. Number 1 will be the sector. So obviously you want to compare companies that are in the same sector, or at least a very similar sector, and sometimes that's difficult to obtain. The deal size is not the same if we are talking about a deal that was $10 million or a deal that was $100 million. So that difference it has an impact on the type of multiple that you'll be getting. And obviously, timing and geography. These are all things that probably will have an impact, and we really need to make sure that we are able to differentiate both. So the big question, what drives value? As an entrepreneur, as an investor, as a shareholder, what drives value in my company? I'd say that the number 1 value driver nowadays is revenue growth. right? Especially in your space, you want to grow revenue. That's the bottom line. You want to make sure that you're growing, I would say anywhere between 50 to 100%. It's ideal. If you're growing less than that, you need to be able to make sure that you have the right plan established so you're able to continue that steady growth rate over the years. So buyers like to see that type of growth rate. And talking about revenue, the recurring revenue side is very important as well. So again, we're seeing a lot of buyers out there looking at recurring revenue because at the end of the day, business continuity is very important. When you are buying a company, you're actually acquiring the market share, you're acquiring the customers, but ultimately you are acquiring that revenue, that recurring revenue stream. So it's very important. Also, we're seeing a lot of customer retention discussion. So the ability of a company to really retain those customers, it's good that you're acquiring new customers, but it's also very important that you're retaining them. So if you have a high customer retention, that's going to ultimately impact value. So if you have customer retention over 80, 85%, that's really good. You always want to have a very significant addressable market. So at the end of the day, that's equivalent to market share. The bigger the market, the more probability you have of capturing part of that market and growing. So if you have a huge total addressable market and you're growing the business, that's very, very important looking into the future. Finally, having a solid management team really makes a difference. Buyers, and as a valuation practitioner, I can tell you that I perceive risk when there's a one-man show. I perceive risk when I don't see a solid management team. When I perceive risk when there's a high probability that you have a sales manager that can leave and can take half of your clients away. So that type of thing is really important to consider. And so we look always at the management team as a value driver. Well, talking about recurring revenue, what are the things that impact that recurring revenue? Obviously, we've talked about customer retention. Brand loyalty is always very important. Brand loyalty and awareness, that helps you, attract new revenue, attract new customers, increase market share. And ultimately as well, the more product stickiness you have, the easier it is to engage into cross-selling opportunities, which ultimately can impact your bottom line. So talking about normalizations, I briefly mentioned the fact that this is a very interesting and sensitive analysis that we do every time we get a P&L and we really understand and try to get the fat out and really focus on the muscle. So these are all non-recurring, non-operating, discretionary events that especially small and medium-sized businesses engage. And obviously, at the end of the day, we really want to see what's the true performance of the business, right? So we'll do that exercise. We'll sit down with the client and really understand, okay, what happened here? Is this an expense that it's related to your operation or no? If it's not the case, well, we'll have to analyze and justify the fact that since it was a one-time expense or it's not related to that company, or maybe you sold a non-operating asset, or you engaged in some sort of litigation that eventually impacted your bottom line. Those are all events that can be adjusted, and you can reflect an EBITDA that really reflects your business operation. These are some types of normalizations that we usually engage in. So for instance, we've had companies go through a downtime and they need to restructure and they need to sell, a new line of business that didn't, went well, and so that restructuring expenses, all of the expenses associated with that exercise need to be normalized because that was a one-time event. So you want to get rid of those expenses associated with that event. Especially when you have small businesses, you have probably an owner that, for tax purposes, he's using the company's, money to get some perks or what have you. So all those personal expenses as well, they get normalized. So really at the end of the day, we're looking at the true performance of the company from a financial standpoint. So if you were investing in a new line of business, we can also normalize that additional expense. So we can compare historic growth with current growth and really make sure that the company does not get penalized because of the fact that you are growing and you're investing into a new line of business. So, anything from lawsuits, discontinued operations, gains and losses from non-operating assets, all of that gets normalized. So it's really important to, when we're doing the valuation of the business, really understand what's the nature of your business and really try to, differentiate what's the operating side of the business from the non-operating side. So basically take out everything that impacts your EBITDA and really look at the true and real values of the business. So what destroys value? Probably the opposite of what we just talked about. So really, again, if revenue growth was a value creation, value enhancing activity, low growth probably is the most in your space. So you want to make sure that you're growing at a very healthy rate. And that helps and attracts buyers to the table. You also want to avoid having, if you have a high customer concentration, if let's say 25, 30% of your business is, resides in just one customer, that has a lot of risk. That entails a lot of risk. Anything can happen to the customer. They can leave, and you'll have an impact right away. So it's really important, and we do this all the time with our customers, is really trying to diversify, not just geographically, but with clients to make sure that at the end of the day, you don't have more than 10% concentration on each one client. Also, you want to make sure that you have a solid management team. So in this case, we've seen sometimes a high dependency on specific individuals. Maybe you don't have a board, maybe you don't have the right processes established, maybe you don't have a succession plan, maybe you don't have a solid strategic plan looking 3 to 5 years down the road. So these are all things that when we get into due diligence, that's going to impact, in the case of a sale, obviously, that's going to impact the value. So these are all things that if I am a buyer, I'm going to be looking at to see if I can lower that multiple as much as I can. And vice versa. This is just for illustration purposes. This is an exercise that we use in financials. So these are some of the companies that, these are not transactions. These are the valuation that reflected based on their financials. So when we plotted them to the matrix, we saw that there's a strong correlation between the enterprise value and revenue growth. So, most of the time, the companies that are growing the fastest, they have the highest revenue multiples. And so it's just an example. Again, this is a sample, and this is based on SaaS, big data, and B2B businesses. So it tells you and really reflects the fact that the higher the growth, the probability of getting an enterprise value is even higher. These are also global trends that we've seen based on EBITDA multiples. So it's been quite a bumpy road in the past 5 years, but ultimately what we're seeing is that we are getting to a point where historically we are at the highest level. So it's a good time to be out in the market. It's a good time to really make improvements. And so despite the fact that we've had some downturns over the past few years, at the end of the day, we need to go and buy new companies. As buyers, as entrepreneurs, as investors, we're always looking to merge. We're always looking to get into new markets. So it's part of the M&A activity. So finalizing my presentation today, a couple of key takeaways. We actually recommend that you do at least one valuation within the first 3 to 5 years of starting your business, because that gives you a reference, that gives you a north of where are you headed, what needs to be done. And eventually every 3 to 5 years thereafter, kind of do an exercise, evaluation exercise. Again, looking at it from a dynamic perspective and seeing, okay, I did this 5 years ago, I'm going to do it now and see how things have changed. Where am I, where are my strengths, where are my weaknesses, where do I need to, what are my biggest areas of improvement? What is it that I really need to address at this time? What really is a big opportunity for me right now? So again, if I'm able to do this on a continuing basis, it's really going to help me, and I think you're going to be able to get much more information and action plan specific items than just doing it isolated or only once. So again, if you identify your key value drivers, each business is different, each sector is different, they operate under different circumstances, so you really need to look at your business and really identify what is it that really drives value in my business. Is it recurring revenue? Is it the type of customers that I have? Is it my management team? Is it the fact that I have a product that has a huge differentiator from my competitors? What is it exactly, and how does it impact that enterprise value? All right, so I also want to look into the industry trends. I want to look into what opportunities are out there. We were talking this morning about mergers, about partnerships, and so all this information is really good for businesses to really move on. Maybe it makes more sense to partner than to develop and engage into R&D. It maybe doesn't make any sense from my business perspective to really acquire or export services or establish an operation in South America. I'd rather partner with someone who's already there. So all of this information and all these trends are important to kind of integrate it into my enterprise value analysis, because at the end of the day, what's important is really to maximize shareholder value. Again, planning, right? If I have a long-term plan, there's a high probability that I'll be able to get there. It might take me more time, but eventually I have an action plan and I can achieve my goals. If I incorporate the valuation analysis, I can really be able to accomplish and achieve those value-enhancing projects that ultimately will have the highest impact on my valuation, and ultimately be able to avoid downside. Obviously, partner with the right people that can, take you to the next level. We've been down that path before, so there's a lot of information that we can leverage from past deals and past relationships, and again, in these 4 niches that really, at the end of the day, make a difference on how do you benefit from all of this. And it's important to prepare for an exit. If you're thinking of an exit, it's really important to plan. Again, exit planning doesn't happen overnight. It takes time, and things happen in between. So it's really important to have a long-term strategic plan to make sure that you're able to achieve your personal and financial goals. So I have not received any questions. I'm scared. So if you have any questions, comments, yes?
Nice pillow. So you can look at the valuation, EBITDA is obviously a big part of it, and projection. How do you figure in goodwill?
It's a very good question. Goodwill is a very important part of the valuation. Usually from a theoretical standpoint, valuation is the difference between the enterprise value and book value, right? We look at goodwill from a practical standpoint. So we want to capitalize on new customers. We want to capitalize on recurring revenue. We want to capitalize on market share. And so, I'm not going to get into the technical side of it, and I can talk to you later on. But really what we try to do is incorporate all of those variables into the forecast. So for instance, if you have just signed a very important player in the industry, if you have signed a huge long-term contract with a huge client, we'll incorporate that into the forecast. So we'll be able to be more aggressive because of the fact that you have a solid reason for that.
Hey, last year you guys had a slide that broke down acquisitions in the past 12 months based on the company type. So like security versus software and such. I know you noticed you didn't have one this year, but do you have any intel or anything you can share with us on kind of the deal size for the company type?
I don't have that information right now because
Okay.
more of this year's focus was more in valuation rather than M&A, but I believe I'll be happy to share that information with you. Question back there?
Do you guys value in human capital?
Yes, we do.
And relative to you know the way we've looked at it in the past is valuing the tech team, but how do you guys look at human capital in the grand scheme of things?
Well, human capital is part of goodwill. Really having the right people in the right team really makes a difference. So again, if I have a strong management team, if I have a strong operating team, I can be more aggressive in terms of the valuation multiples. I can be more aggressive in terms of the forecast because I have a solid team. So that will be incorporated into the forecast.
What if your widget you seem is somewhat different than what's out in the marketplace? How do you try and get a valuation if it doesn't fit in the right shoe? In other words, if it's somewhat unique.
Could you explain that again?
Well, what I'm saying is that if I'm going to sell a widget, if a company's going to sell their product type, and it doesn't fit in with what your other analyses are with, there's nothing similar in the industry, then how do you value that?
Well, if you're selling a prototype that has not demonstrated any revenue capability or any free cash flow
No,
capability.
no, I'm not saying that. I'm saying there's plenty of cash flow with it, but you're trying to say what similar companies or types have sold, but there aren't any.
If you don't have any comparables, you will try to justify, obviously you can do it from a discounted cash flow perspective.
Right.
From a comparable perspective, if you don't have any, you'll need to kind of, pick an industry that's kind of relative, similar in size, and be able to justify it. It's difficult, but you can do it.
Yeah, thanks.
One of the other things that we do is we'll look at your business, and if it's very unique, we might say, okay, here are the top 10 buyers, prospects, and how would the incorporation of your software into their company impact their bottom line? So if you bring so much incremental revenue and incremental EBITDA to that company, we expect a part of that to come back to you in the valuation of your business.
Yeah, obviously, if you are in a deal and you are dealing with a synergistic buyer, you can always benefit from some of those synergies. So that also can impact your value. Yeah.
Most recently, are we starting to see some valuation softening, with the general market? Just kind of been hearing some rumblings of that.
We saw some revenue multiples hit a correlation in terms of SaaS, specifically in the SaaS industry. So SaaS last year was very, very hot. The beginning of this year, it saw a correlation. It's going up, but they saw a significant correlation just in SaaS. So big data and B2B, they were pretty steady. SaaS was growing much, much faster and hit a correlation again late last year, early this year. And still, it's kind of picking up, but
Great,
yeah.
thank you.
Sure. More questions?
I'm curious about how you factor in the canary in the coal mine. So, for example, a trending on increased litigation or insurance payouts in a particular sector, does that carry a negative weight?
If it's a one-time, no. If it's recurring, yes. So
And also whether or not it's ongoing, because there are some litigation issues that are currently out in the market that buyers are just not putting bids on companies until those litigation issues.
I'm not speaking about a litigation with the company in question, but in companies similar to the company in question, if they're starting to experience issues with insurance and lawsuits and litigation, does that put your company that you're trying to value in danger of being potentially a future subject of a lawsuit or some sort of insurance problem that might damage the value?
Well, as a valuation practitioner, everything that I perceive as risk will ultimately have an impact on enterprise value. If I see that as, again, as a one-time event, as a non-recurring, non-operating event, I can justify it because of the fact that that happened for whatever reason, but there's a high probability that that will not continue to operate into the future. And again, that's a set of assumptions that you need to make when you're valuing the business. So if it's a one-time event, then probably you can normalize it and you and the company will not get affected as much. But if you can perceive that risk as ongoing, as recurring, and there's a high probability that that will continue to happen, then definitely it'll be a big impact on value. So, no more questions. It's been a pleasure to be here. If you want a free business consultation on valuation, I'll be more than happy to share that information with you afterwards, or you just send me an email and we can talk. So thank you very much.